Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Now I'm going to start a new subject, Financial Decision Making 1. So in this new subject, the contents, the topics to be covered are financial statement analysis, first topic. Second, ratio analysis, market profitability analysis and special issues. Financial management, raising the capital, working capital management, and corporate restructuring and international finance. So these are the topics, 7 topics I am going to cover up in this subject, that is Financial Decision Making 1. So in this subject, the first topic I am going to take up is financial statement analysis. In this video, I am going to explain you what are financial statements, what are the methods of analyzing the financial statements, and how to prepare, how to make the analysis of financial statements. All these things theory I am going to explain. In the next video, I'll start the problems on this financial statement analysis. So before starting the explanation of this financial statement analysis, take a screenshot of the points which I have written on the board. Then I'll explain all the details regarding financial statement analysis. So first of all, I'm going to explain you about the meaning of the term financial statements. What are financial statements? The financial statements are the end product of accounting. Accounting is a process which begins from passing the journal entries and then posting them into ledger accounts. And this journalizing and posting will be conducted throughout the year. At the end of the year, all the ledger accounts will be balanced. And we have to calculate how much is the carried down, brought down balance in every account. Some accounts may show debit balance, some accounts may show credit balance. Now in a statement, we take up all the debit balances in one column, credit balances in another column, we make a trial balance. So when the trial balance agrees, it means there are no errors in the books of accounts. Now we proceed to prepare the financial statements. So traditionally, financial statement consists of income statement and balance sheet. The income statement is also known as statement of profit or loss. And balance sheet is also known as statement of financial position. So these two, that is statement of profit and loss and balance sheet, these two are called the financial statements. So every business will make the statement, financial statements, every business, whether it's a sole trading business or a partnership business or a joint stock company, every business will make these financial statements. But apart from these two traditional financial statements, some new financial statements are being prepared, particularly by joint stock companies. That is statement of shareholders' equity and cash flow statement. So presently, by joint stock companies, 4 statements are prepared. Income statement, statement of financial position, then statement of equity, shareholders' equity, and lastly cash flow statement. But we focus in this chapter only 2. That is statement of profit and loss and balance sheet. These are the financial statements. Only preparing the financial statements is not the end of the matter. After preparing financial statements, there is a need to analyze, to interpret. Then only we can be able to get a lot of information from the financial statement. And this information will be useful in decision making. So the steps involved: first journalizing, then posting them into ledger accounts. At the end of the year, trial balance is prepared. From the trial balance, we make the financial statements. After making financial statement, we have to analyze the financial statements and then interpret the financial statements. These two terms are different, analysis and interpretation. Analysis means simplification technique or making the relationship of different variables in the financial statements. Financial statement consists of so many variables. Now we are making a relationship between the variables. That is called analysis. After analyzing, we have to find out the reasons. That means whatever changes taking place in the financial statements, what are the reasons? What is the conclusion? That is called interpretation, right? So these are the financial statement. Now meaning of financial statement analysis. So after making financial statement, we have to analyze it and give the interpretation. So what do you mean by analysis? Making a relationship of different variables in the financial statements. Just like in income statement, that is statement of profit or loss. We have so many items. Revenue from operations are there, other income is there, cost of material consumed, and employee benefit expenses, depreciation, other expenses. So many items are there. So we can make the relationship between different variables. That is called analysis. Now, methods of financial statement analysis. There are many methods of analyzing the financial statements, but the most commonly used methods are comparative statement analysis. Secondly, common size statement analysis. Thirdly, trend analysis. Next one, ratio analysis, etc. Still many more are there. But for our subject, for our purpose, only 4 topics we are considering. Out of these 4, 3 topics we are discussing and we are doing the problems in this chapter. And ratio analysis, the next chapter will take up ratio analysis separately. But right now, we focus only on comparative statement analysis, common size statement analysis, and trend analysis. These 3 topics I am going to explain and will do the problems on these 3 techniques. First of all, comparative statement analysis. Comparative statement analysis is also called horizontal analysis. In this, we compare one year figure with another year figure to find out what is the absolute change and percentage change. So, comparative statement analysis is comparing one year's data with another year. For example, 2 years are given, 2018, 2019. So last year is 2018, current year is 2019. So we want to compare this 18 and 19 year to find out the absolute change and percentage change. So this comparative statement analysis is also called intra-firm comparison. Intra-firm means within the same firm. Same firm, we are comparing 1 year data with another year data. That is called comparative. Now, what is the format of making this comparative statement? 4 columns we open. 4 columns. At the extreme right hand side, 1 column will be particulars column. Leaving this particular column, 4 columns. Previous year, PY stands for previous year. CY stands for current year. Previous year is also called the last year. So last year, current year. Then absolute change, percentage change. So this is the format of making comparative statement. Now absolute change value. How to find out this absolute change value? Current year minus last year. Suppose current year is 1000, last year is 800. So 1000 minus 800 is 200. So absolute change will take 200. Example, with the help of an example I will show you. Here current year value is 1000. Last year value is 800. For example, I will take it 1200. Current year value 1200. Last year value 1000. So 1000 last year, current year 1200. Absolute change is equal to current year minus last year. 1200 minus 1000, you will get 200. 200 is the absolute change. Now percentage change, if you want to find out, absolute change divided by previous year value into 100. So absolute change how much? 200. And what is the previous year value? 1000. So 200 divided by 1000 into 100. 200 divided by 1000 into 100. You will get 20%. That's all. This is the method of calculating the comparative statement. In the next video, we'll do the problem practically. I'll show you how to make the comparative statement analysis. Right? Then next method is common size statement analysis. The second method of financial statement analysis is common size. It is a form of analysis and interpretation of financial statements. All these are the analysis method. So common size statement is also one of the method of analyzing the financial statements. It is also known as vertical. Remember, this comparative statement is called horizontal analysis, whereas common size is called vertical analysis. Vertical analysis. Then in this method, all the items are expressed as a percentage of base item. First of all, in the financial statements, you have to select a base item. A base item. And we express all other items as the base, as the percentage of base. So simply we are condensing the data. Example, in case of income statement, the base item may be sales for statement of profit or loss and total assets in case of balance sheet. So if you are making common size income statement, in that case sales will be taken as the base. Sales will be taken as the base and express all other item as a percentage of sales. So if you are making a balance sheet, the base is total asset. So total asset will be treated as base and express all other items as a percentage of total assets. So these two remember, sales and total assets. Now a common size statement facilitates comparison of financial statement of not only a single firm but also comparison of financial statement of different companies. So inter-firm and intra-firm, both comparison we can do in common size. But in case of comparative statement, only we can make intra-firm. We cannot make inter-firm comparison. We can make only intra-firm within the same firm. But common size statement can be applied either for intra-firm or for inter-firm comparison. We can make use of this common size statement. Now percentage is calculated by the following formula. So how to calculate the percentage value? Here formula is amount of individual item divided by amount of base item. The base item may be sales or the base item may be total assets. If income statement is prepared, base is the sale. If balance sheet is prepared, total assets is the base. So denominator we can take either sales or total assets. Income statement we take the sales. Balance sheet we take the total assets. This is the percentage of item formula. Now advantages of common size statement. There are many advantages of applying the common size statement analysis. The first one, easy to prepare and simple to understand. In the next video, I'll explain you practically how to prepare the common size statement. It's very simple, easily understandable. So that is the main advantage of common size statement. Secondly, component analysis. Component analysis means we can find out what is the importance of each item of the financial statements compared to the base. Because we are calculating percentage of every item to the base value. In this way, every component, which component is more important, which component is less important, we can be able to find out. Thirdly, comparison across years. We can be able to compare a number of years. Not only for 2 years, but a number of years we can be able to compare by making common size statement analysis. Next one, facilitates both inter-firm and intra-firm comparison. The common size statement analysis can be applied whether intra-firm. Intra-firm means within the same firm, 1 year with another year. That is intra. Inter-firm comparison, comparing the performance of one company with another company. That is called inter-firm comparison. The advantage of common size statement is we can apply for intra-firm comparison and also for inter-firm comparison. Next, fluctuating numbers. If we do not make this common size statement analysis, it will be difficult to compare the fluctuating numbers. Numbers are all fluctuating in the financial statements. We cannot be able to come to some conclusion. If we express all the items as a percentage of base, then we can be able to make some sense. We can be able to come to some conclusion. So these are the advantages of making common size statement. Now what are the limitations? We don't have only advantages. We have some limitations also of common size statement. What is the first limitation? Static view. Static means constant view. We are preparing this common size statement on a particular date. So after making this common size statement analysis, then the conditions might be changed. So whatever decision we are taking on this static statement, but the conditions of the business may change. So our decision may go wrong because we are using that static data. Now the conditions might have changed. Secondly, focused on past performance. Only historical data will be used for making this common size. But do you think that past will again repeat in future? There is no guarantee. Whatever had been occurred in the past, it is not necessary that it will be repeated in future. In future, the conditions may be dynamic, changed. So we cannot get the full advantage from common size statement. Next one, does not provide reasons. That means this the common size statement will just explain the changes, the percentages. Why these changes occurred? What are the reason for the changes? We cannot be able to know. The reason for the changes will not be known from the common size statement. Next one is limitation of financial statements. The financial statement itself suffers from a number of limitations. Example, the financial statements are prepared from the historical data. The financial statements are prepared on different accounting methods. Similarly, the financial statements will consider only monetary figures. Non-monetary events will not be considered. The financial statement itself will suffer from so many deficiencies. So automatically, common size statement analysis will also suffer from those limitations, because common size statement is based on financial statements. So if you want to make correct common size, you must make correct financial statements. So these are some of the limitations of common size statement. Next thing is format. How to make the format? Here I have shown you the format of comparative. Here this is the format of common size. Only two columns, amount column and percentage column. That's all. So this is the end of common size. So far I have explained you comparative statement analysis and common size statement analysis. Now the third one and the last one is trend analysis. Trend analysis is very similar to comparative statement analysis. In comparative statement analysis, we are comparing 2 years, last year with the current year. But if we extend our study for more than 2 years, then it will be called trend analysis. That means we are comparing the performance of the company over a period of time. That means we are comparing the performance in 4 years, in 5 years, like that. More than 2 years. So if you want to compare the performance for more than 2 years, trend analysis. If you want to compare the performance of only 2 years, comparative is enough. Only 2 years. So here trend analysis is an extension of comparative statement analysis. It is very useful and effective tool for horizontal analysis of financial statements. Just like comparative. Comparative is horizontal. Common size is vertical analysis. So this is also horizontal analysis, trend analysis. Trend analysis involves computation of index number of the movement of various financial items. Index numbers we are calculating. So how to calculate index number? We have to treat one of the year as the base year. Suppose if 5 years data is given, the first year normally we take it as the base year. Now we express all the values as a percentage of the base year. Percentage of the base year. For example, we are given 5 years data. The 5 years are 2015, 16, 17, 18, 19. So 15, 16, 17, 18, 19, 5 years. The first year is 2015. So 2015 is called the base year. And we take all values of base year as 100. Here I will show you. It helps in understanding the nature and rate of movements. How the variables are moving, changing. So trend, nature of change in the values we can be able to understand by making this trend analysis. The steps in computation of trend values. How to compute? First, select one of the period as base year. While calculating trend analysis, the first step is select one of the year as the base year. So normally we will take the first year as base year. Second, every item of the base year should be taken as 100. So after selecting the base year, take all the values of the base year as 100. Then trend values of each item of any other period can be calculated as follows. The other trend values can be calculated by using this formula. So absolute value of the current period divided by absolute value in the base period into 100. So current year value divided by base year value into 100, you will get the trend values. That's all. So these are the three techniques of financial statement analysis. The three techniques are comparative statement, common size statement, and trend analysis. This is only theoretical. By doing some few problems on these methods, the concept will be more clear. But from examination point of view, not only problems, but they may ask you in theory also. What is common size statement analysis? What are the advantages and limitations of common size? So whatever I told you, whatever I explained you now, if you listen, if you watch with full concentration, you can be able to attempt the theory question also on this common size, comparative, and trend analysis. So this is the end of this theory part of financial statement analysis. In the next video, inshallah, I will start the problems on financial statement analysis. So if you are new to my channel, I suggest you to go to the playlist of my channel. Select the subject you want. I have uploaded so many subjects of accounting, management, finance, etc. For BCom, MCom, BBA, MBA, CA, CMA, CS, all these videos are very, very helpful. So go to the playlist, select the subject, watch the video, enhance your knowledge. And do subscribe my channel if you have not yet subscribed, and give your comment from which university you are pursuing your course and from where you are watching this video. And give the link to all your friend circles so that more students can watch the video. Share the link of my channel with all your friends so that more students can watch the video and enhance the knowledge. Inshallah, we'll start the problems on financial statement analysis in the next video.